Your bank raises your credit card rate by 2 percentage points. A wealthy household barely notices. You cancel a grocery trip, delay a dental visit, and call it budgeting. The same interest rate move has just taken more from you than from someone earning 5 times as much. That is the uncomfortable purpose of higher interest rates. A central bank raises rates to slow spending, cool demand, and bring inflation down. But the pain is not divided equally. It reaches the households with the least financial padding first. A 2026 study by Aditya Aladangadi, Ricardo Duque Gabriel, and Carlo Wicks used spending information connected to more than 350 million credit cards across over 30 U.S. counties. After monetary policy shocks, spending fell more in lower-income counties than in higher-income ones. In plain English, when rates jump unexpectedly, poorer communities cut back harder. Why does the same policy produce two completely different experiences? Start with cash flow. Cash flow is simply the money entering and leaving your account each month. A high-income household may have $10,000 coming in, several thousand going out, and a large gap in between. A lower-income household may have $3,000 coming in and almost exactly $3,000 going out. Now add a $200 increase in monthly debt payments. For the first household, that may reduce investing or restaurant spending. For the second, it can erase the grocery budget. The percentage point change is identical. The consequence is not. This is why economists care about something called the marginal propensity to consume. That phrase means how much of each extra dollar you are likely to spend. When your budget is already tight, nearly every dollar has a job. Lose $1 of disposable income, and spending usually drops immediately. Greg Kaplan, Benjamin Moll, and Gianluca Violante built this reality into their 2018 HANK framework. HANK stands for Heterogeneous Agent New Keynesian. The name is ugly, but the idea is simple. Households are not identical little robots with matching bank accounts. Some own stocks, property, and cash. Others own a paycheck that disappears by Friday. Traditional textbook models often imagine that higher rates mainly work because everyone chooses to save more and spend less. HANK models show a harsher channel. Rates change jobs, wages, debt payments, asset prices, and government finances. Those changes hit households differently because their balance sheets are different. Picture two people. You earn $40,000, rent your home, carry a credit card balance, and have $800 in savings. Your neighbor earns $200,000, owns a house with an old fixed-rate mortgage, holds treasury bills, and keeps $50,000 in cash. Then, rates rise. Your credit card interest gets more expensive. A future car loan costs more. Your landlord may face higher financing costs and push for higher rent. Your employer sees weaker sales and freezes overtime. Your neighbor gets a different letter. The yield on safe savings and treasury bills is higher. The old fixed mortgage does not change. Falling stock prices may look unpleasant, but your neighbor has cash available to buy more. One person receives a squeeze. The other receives an opportunity. Suppose you carry a $5,000 credit card balance, at an annual rate of 18%. The rough yearly interest cost is $900 before repayments change the balance. At 24%, it becomes about $1,200. That extra $300 is only $25 a month, which sounds small in a policy meeting. In your kitchen, it can be a phone bill, medication, or several meals. Now combine that with a more expensive car, repair loan, slower wage growth, and fewer work hours. Higher rates do not need to bankrupt you in one dramatic scene. They can remove $30 here, $50 there, and one shift next week. Your financial life dies by subscription. The credit market makes the split even wider. When the economy weakens, lenders become more cautious. They demand better credit scores, larger deposits, or higher rates from people who already look risky. Ben Bernanke and Mark Gertler describe this amplification through the credit channel. Tighter money weakens borrower balance sheets. Then, weaker balance sheets make borrowing even harder. So the person who most needs flexible credit is offered the worst credit. The person who least needs a loan is offered the cheapest one. Banks call this risk pricing. Your wallet may use a less polite phrase. There is also the employment channel. Higher rates discourage borrowing for homes, equipment, expansion, and inventory. Businesses cut investment. Construction slows. Hiring cools. Who usually loses negotiating power first? Not the executive with equity and a severance package. It is the hourly worker, the new employee, the contractor, or the person whose schedule can be reduced without a press release. A small fall in total employment can hide a large shock concentrated among financially fragile workers. The early 1980s show the extreme version. Federal Reserve Chair Paul Volcker raised interest rates aggressively to crush entrenched inflation. Inflation eventually fell, which mattered enormously. But the economy also went through severe recessions, unemployment rose sharply, and interest-sensitive industries such as housing and manufacturing were hit hard. That history reveals the counterintuitive twist. Higher rates can help poorer households in the long run because high inflation also punishes them disproportionately. Food, rent, transport, and electricity consume a larger share of a tight budget. A wealthy household can absorb higher grocery prices. You cannot diversify away from dinner. So the real choice is not kind policy versus cruel policy. It is often immediate, visible pain from higher rates versus slower, less visible pain from persistent inflation. Central banks are trying to stop the second by creating some of the first. The problem is that the households asked to reduce spending fastest are often the households that created the least excess demand. What can you actually do with that? First, treat variable rate debt as a fire near dry grass. Credit cards, adjustable loans, and repeated buy now pay later plans become more dangerous when rates remain high. Paying down the highest rate balance is not glamorous, but neither is donating interest to a bank. Second, build liquidity before chasing returns. Liquidity means money you can access quickly without selling an asset or taking a new loan. Even a small cash buffer changes your response to a surprise bill. Without it, an emergency becomes expensive debt. With it, an emergency remains an expense. Third, separate the rate you earn from the rate you pay. Higher rates can reward savers, but earning 4% on $1,000 does not compensate for paying 24% on $5,000. Banks are very comfortable letting you admire the first number while ignoring the second. Finally, watch your income risk, not only your expenses. When rates are high, overtime, commissions, freelance work, and new job openings may weaken before your fixed bills do. A budget based on your best month is a trap. Build it around a normal month, then use stronger months to reduce fragile debt. Higher interest rates are designed to make someone spend less. The system does not choose that person randomly. It reaches variable rate borrowers, renters, workers with unstable hours, and households without cash reserves first. Your bank raises your rate by 2 percentage points. Now you know why a wealthy household barely notices, and why protecting $25 in your monthly budget may be more powerful than pretending the same interest rate hits everyone equally.